Hi everyone. Welcome to my channel, InfoCraze, where we simplify finance, accounting, and job preparation for your career success. In this video, we will discuss some important questions that may be asked in a job interview for FP&A. If you like the video, please subscribe to my channel and hit the bell icon so that you get instant notifications for my future videos. So, what is FP&A? FP&A stands for Financial Planning and Analysis. Now, let's start with question number 1. What are the key responsibilities of the FP&A function in a company? FP&A is primarily responsible for financial planning, budgeting, forecasting, and performance analysis. In senior positions, one may also play a key role in partnering with business units to drive strategy, performing variance analysis, and scenario modeling, making investment decisions and cost optimization. Providing insights to the CFO and CXOs for better decision making. Now, let's look at the question number 2. What is the difference between budgeting and forecasting? Budgeting is a fixed financial plan for a defined period, usually a fiscal year, based on expected revenues and expenses. It's used for setting targets and allocating resources. On the other hand, forecasting is a dynamic, ongoing estimate of future performance, often updated monthly or quarterly, based on actuals and revised assumptions. For example, the budget may show 500 crore rupees revenue for FY25, but if Q1 underperforms, the forecast may adjust the full year estimate to 450 crore rupees. Hope it's clear. Let's take up the question number 3 now. How can one ensure accuracy in financial forecasts? Forecast accuracy can be improved by using driver-based models like headcount, sales pipeline, productivity, etc. For example, revenue may be linked to billable hours or units sold, while expenses could be tied to headcount or production runs. Next one is regular updates from business stakeholders. Forecasts are only as good as the assumptions behind them. So, maintaining ongoing communication with sales, operations, HR, and delivery teams will be helpful to derive the best estimates. In fast-changing environments, there may be a need to update forecasts monthly or bi-weekly to reflect the latest on-ground realities. Next is sensitivity and scenario analysis. Analyzing various what-if scenarios to test the impact of key risks and opportunities on financial performance is quite useful. This includes the best case forecast, that is, optimistic scenario, base case forecast, that is the most likely scenario, and the worst case forecast, that is the pessimistic scenario, which are particularly useful for CFOs and COOs during strategic decisions. It helps management prepare mitigation plans for downside scenarios, such as client delays or cost escalations. Another important factor is the automation tools like Excel, Anaplan, Oracle Hyperion, or Power BI. Automation reduces manual errors and ensures data is pulled directly from ERP or HRMS softwares. It also helps in creating real-time dashboards, allowing quick adjustments when new data becomes available. Next, question number 4. Explain the concept of operating leverage and how does it affect decision making? Operating leverage, that is OL, refers to the extent to which a company's cost structure includes fixed costs as compared to the variable costs. It measures how a change in sales volume will impact the operating income. That is, the EBIT. Companies with high operating leverage have a larger proportion of fixed costs. Example, rent, salaries, depreciation, etc. This means that, once the fixed costs are covered, any additional revenue significantly increases the profits. However, in periods of low sales, high fixed costs can lead to greater losses, making such businesses riskier in downturns. Understanding operating leverage helps in a. Strategic planning. Operating leverage helps assess whether to scale operations. High leverage can amplify profits with volume, but increases risk in volatile markets. B. Pricing decisions. Firms with high leverage may accept lower prices to increase volume and cover fixed costs. C. Cost management. Leaders may shift to a more variable cost model, like outsourcing, hiring temporary workers, etc., to reduce risk. D. Break-even analysis. Operating leverage influences how much sales volume is needed to break even. Degree of operating leverage, DOL, is equal to percentage change in EBIT divided by percentage change in sales. EBIT means earnings before interest and taxes. It may be noted that a higher DOL means greater sensitivity of profits to changes in revenue. Let's take an example. There are two companies A and B. Company A has high fixed costs, and Company B has low fixed costs. If both the companies increase their sales by 10%, operating profit of Company A increases by, say, 25%, whereas operating profit of Company B increases by, say, only 10%. This shows how Company A has higher operating leverage, which is great during growth, but risky in a downturn. Now, question number 5. What is variance analysis and what are the key types? Variance analysis is the process of evaluating the differences between planned, that is, budgeted or forecasted financial outcomes and actual results. Its goal is generally to find out the deviations, if any, and identify the underlying causes. Key types of variance analysis are revenue variance. This variance analyzes whether changes in sales are due to differences in the number of units sold, that is, volume variance, or changes in the selling price per unit, that is, price variance. This helps isolate demand-related issues from pricing strategy problems. Then, we have the cost variance. Cost variance breaks down whether overspending is due to a higher unit cost, that is, rate variance, or consuming more resources than planned. That is, usage or efficiency variance. It's crucial for managing input costs and operational efficiency. Next is SG&A variance. SG&A variance examines deviations in overhead and administrative expenses compared to budget, helping identify unplanned spends in areas like travel, consulting, or recruitment. Next, we have the working capital variance. This variance tracks changes in components like receivables, payables, and inventory versus planned levels, highlighting impacts on cash flow. Variance here can signal efficiency gaps or shifts in customer or vendor behavior. Hope you have understood all these questions that we discussed till now. If you have any question, please put your query in the comments section. FP&A being a vast subject, I will make more videos on this topic. In case you want me to add any specific question on FP&A in my future videos, please let me know. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Additionally, please subscribe to my channel for many such interesting videos. Thanks for watching.